and get more markets analysis and welcome Kathryn Rooney Vera, Chief Market Strategist at StoneX Group. What happened last week, right? You look at the NASDAQ 100. We have the biggest weekly decline since March, the week where the banking crisis kind of unfolded. Bitcoin hits a one-year high Friday. What was driving both of those things?
Well, all signs point to the Federal Reserve driving most of the market action and the expectation of additional rate hikes being discounted after previous to that the market had wholeheartedly embraced the idea of rate cuts being the next step for the Federal Reserve. The dot plot shows that the Fed is expecting 2 more hikes at 25 basis points each, but even today, Ed, the markets are not believing the Fed and expecting 1 rate hike. This week, I think economic data are going to be clutch in terms of market movement going forward, whether the economic data from, for example, initial jobless claims, core PCE, the super core index, all of that coming out this week, indicating whether or not the market is right or the Fed has got it right. So I think that's where the markets are focused, especially as you highlighted on the technical or the technology sector, which has been the foremost front runner of this rally that we've seen year to date.
Kathryn, what does the Fed need to see in that data to move from hiking to pausing to eventually cutting rates?
There has to be irrefutable evidence that the labor market is rolling over. There has to be a clear trend, not just this data dependency focused on 1 or 2 months, a clear trend with regard to the super core, which is what the Fed most looks at, ex-shelter, of course, which seems like it's going to start a trend lower. But there really has to be trends with regard to getting to the 2% core PCE target. This is a Fed that has grappled with credibility. Remember the fiasco with regard to transitory inflation, overrunning the easing policy for I think went long in the tooth by about a year. So I think the markets could be disappointed, Ed, with regard to the Fed's propensity to prop up economic growth versus inflation. I think this is a Fed that really needs to claw back some inflation-fighting credibility, and more likely than not will hike or hold rates at a term 525, but more likely 550 for an extended period of time, longer than what the market is currently discounting. That in itself is negative for stocks, negative for cyclicals, negative for interest rate sensitive sectors, which technology certainly is.
On that note, we're showing the NASDAQ 100's year-to-date performance up 35% or so. A big part of that story was just a few single names, and it was all AI related. So when you look at the breadth of the market, how do you see investors offsetting that AI hype driving us to the upside and then the Fed risk to the downside?
Well, in the short term, if you believe that the market has further upside, which it certainly could if we get very good inflation data showing that the Fed maybe doesn't have to go so long or so much higher for longer, then you could get additional upside. And if you want to play that trade, Ed, I think that you would want to look at the laggards. So you see this divergence between the NASDAQ and small caps. Then you could play the laggards, such as small caps, financials, or energy. My perspective over the course of the next 6 to 12 months, however, is that we should be disproportionately overweighted on defensive sectors, which have not seen a significant run-up year to date. That has been, of course, in favor of technology, and as you mentioned, this very narrow breadth of the S&P 500's recent surge. So I would say look at defensives in U.S. equities, and specifically look in rates. I mean, you could look at the 2s, 10s, steepener play in the Treasury curve, hold a position in gold, in cash. I mean, even Bloomberg had this beautiful chart you guys put out where it showed that high-grade bonds, earnings yield, and 3-month T-bill are all pretty much within a range of 20 to 30 basis points. So I think the risk-reward favors being defensive over chasing the market.
Thank you for your time, StoneX Chief Strategist.